Welcome to another video from Grandstand Sports Data, and this is going to be our first edition of Letters to Bettors. So it's going to be a full season review of the 2025 NFL season. We're going to be stepping back from the individual games and looking at the market as a whole. So expectations versus outcomes and where the pricing was right or wrong over the course of the season. So everything here comes from our own record keeping. Every game, every line, every result tracked. So we're not dealing with opinions. We're looking at how the market actually performed. Going forward, this is something that we'll do across different sports, both recaps like this, and then we're also going to give you previews heading into next season for multiple sports. So if you find value in this type of breakdown, hit that like button. That's what we'll use to decide how much we expand this series. So let's start with the market first. All right, so let's start with the market as a whole. 2025 was not a public friendly season. What do we mean by that? So if you were consistently on the side getting the majority of bets, you went 117 wins, 166 losses. That's only good enough for a 41% win rate and down just under 60 units. So the obvious side, the popular side, didn't just underperform, it absolutely got spanked. Now, from a pricing standpoint, we're talking about closing line value. That was a clear separator this year. Bets that beat the closing number went 53.8% in terms of the win rate and finished positive for your wallet, while the bets that didn't only hit at 45% of the time and lost over 34 units. So, over a full season, getting the best price mattered much, much more than anything else. Let's move on to the contrarian side. So the contrarian spots, these are the teams taking less than 30% of the tickets. Those went 61% in terms of their win rate. We're up over 14 units, and those situations also closed with better numbers at a higher rate, which tells you that the market was correcting in that direction. Now, let's look at the other market signals. We have the standard sharp indicators. Those were positive. Remember, that is less tickets, but more money. Then when we laid in both a contrarian and being sharp, there wasn't much of a sample size there, but it wasn't profitable regardless. Now, overall, the 2025 NFL showed that being early and unpopular mattered more than being confident and right. And if you were on the public side a lot this season, I'm curious. Drop it in the comments down below. Did it feel like you were always on the right team, but still losing? Let us know in the comments down below. Now, let's take a look at the team level. This is the performance versus market expectations, not wins and losses, but how teams performed relative to the number. Let's take a look at the teams who outperformed. We're talking about Seattle. They were a clear outlier at 16-4 against the spread, up over 10 units, consistently outperforming what the market was asking of them. You see similar but smaller edges with teams like Chicago, San Francisco, and New England, teams the market didn't fully catch up to over the course of the season. Then you have Carolina and Jacksonville. They show up here as well. Not necessarily dominant teams, but teams that provided value relative to their price. Now, on the other side, you have teams the market consistently overvalued. We're talking about the Buccaneers. They finished 5 and 12 against the spread, down over 7 units. Then you have Tennessee, Kansas City, Baltimore, Arizona, all in that same range, losing over 5 units. Those are the teams that either carried perception or were priced at a level they didn't consistently reach. And that's the real takeaway, right? This isn't about who was good or bad. It's about expectations versus reality and where the market didn't align with the performance. Now let's jump on the money lines. This is outcome versus price. How often teams actually justified the probability that they were being priced at. Now, favorites. They won 65% of the games, but still lost over 12 units, which tells you that winning doesn't necessarily translate to value. We know this by now, right? When you break it down, small favorites were basically neutral. Big favorites won at a high rate but didn't generate meaningful returns. And then the mid-range favorites, that minus 150 to minus 250 range, were the biggest drag on the results. Now, on the other side, how did those underdogs perform? Well, the overall record was 34%, but the performance is where it gets interesting, right? Small underdogs were slightly negative, but the mid-range dogs, you're talking about the plus 150 to about plus 250s, there was clear profitability there, up over 11 units. Even the bigger underdogs, despite lower win rates, were able to produce positive returns because the price was compensating for that risk. The only group that really didn't hold up was their extreme long shots, those plus 400 or higher, right? This is where the win rate dropped off too much to justify the payout. Now, so the takeaway here is very simple on this slide. Moneyline prices reflect probability, not certainty. So favorites are supposed to win, but the question is whether they win enough to justify the price. And in 2025, that wasn't consistently the case. Now we take the same idea and bring it down to the team level. So we're talking about performance adjusted for price, not just wins. Let's talk about some of the top moneyline performers. Carolina stands out right away, only 11 wins, but almost 10 units of profit. And that tells you that the market consistently undervalued them. They were priced like an average team, but performed better than that price. Now we have New England and Seattle. They're a little bit of different profiles, high win totals, but still profitable. That's a sign that the market was slow to kind of fully adjust to them. Even as the price increased, they still continued to outperform expectations. Now, Jacksonville and Houston, they fall more into the balance range. Talking about solid win rates, but more importantly, they were priced fairly and still managed to create some positive returns here. On the other side, we talked about the winners. Let's talk about the losers. This is where pricing becomes a little bit dangerous. We're talking about Arizona, Vegas, and the Jets, low win teams, but still heavily unprofitable. The market kept giving them prices that didn't fully account for how bad they were. I also will throw Tennessee in there because they're same record around the same, same concept, really. Let's talk about Kansas City for a little bit, though. This is an interesting one. They won games, but they were consistently overpriced, right? The market wanted to give them those wins, but you were paying a premium for a team that didn't necessarily deliver enough margin relative to their number. So, key takeaway here is simple: more wins do not guarantee more profit. What matters is how those wins compare to the price that you're laying or receiving. All right, so before we go any further, we're going to be shifting back to against the spread for the remainder of this video just to keep everything consistent, but we will move on to the models. And the models, we're going to define them very quickly before we get to the result. We'll define them as we get into the results. I just wanted to give you a picture of what the models did, or the technical analysis side of the NFL this season. We'll start with the benchmark model. This is your baseline. It uses advanced stats that correlate with margin of victory. You've probably seen these everywhere all over YouTube. Well, that benchmark model went 146 wins and 136 losses. It was down over 3 units, so it was not profitable for your wallet this season. Let's move on to the matchup index. And this is a more situational one that we created here at Grandstand Sports Data. It looks at positional groups on each side of the ball and identifies where one team has a measurable edge. Well, that went 108 wins, 113 losses, and it was down over 14 units. Now let's move on to player quality. And it's exactly what it sounds like. Individual player grades, weighted, and then combined into a single team number. Think of it almost like a Madden rating. Well, this went 103 and 118. Another one that was not profitable, down 24 units. And then we're going to jump over to the team efficiency index, which focuses strictly on efficiency metrics that have historically tied to margin of victory over the years. So how well a team actually performs and not just, the outcomes that come with it. So another loser here, 100 wins and 121 losses, down exactly 30 units throughout the season. So each model is attacking the game from different angles. We're talking about baseline, strength, matchups, talent, and efficiency. And what we saw this season is none of them on their own were enough to consistently beat the market. So if you're trying to approach betting like this, data structure, removing bias, make sure you subscribe to Grandstand Sports Data. That's what we focus on each of our videos. All right, so this is where we move away from pure numbers and get into the context. We're talking about the stuff bettors talk about every day: matchups, travel, rest, recent performance, all the things that we feel like you should give an edge or find an edge from. And this is the first thing that you notice, right? Some of it worked, some of it didn't, and most of it was very situational. Let's take a look at location first. This didn't give you an edge. Matchups next. This held up. Favorites in high total games and dogs in low total games both produce positive results. That tells you game environment matters. And remember, high totals are anything over 45 points, and low totals are obviously anything under 45 points. Now let's jump over to travel. Travel mattered too. The 620-mile rule held up with solid closing line value in a small profit. And if you don't know the 620-mile rule, that is betting against a team. So betting against, remember, betting against a team that has traveled 620 miles through the air to go to their opponent. Now, let's talk about some recent performance that also mattered. We're talking about blowout dogs, teams coming off a 10-point or more loss. Those were one of the strongest angles all season. And then we had rivalry spots. They showed up too. Divisional dogs were profitable, which makes sense. Knowing your opponent tightens the gap. But then you look at some of the other areas, and it's a little bit of a different story. Rest was basically neutral, and player quality, even something like Madden ratings, actually performed poorly despite having strong closing line value. Coaching metrics were very similar. Good closing line value, but negative results. And that's from our Grandstand Sports Data coaching model. But remember, if you go back to that video and watched it, we said it was more of a money line model than a spread model, and these are the spread numbers. So, what this tells you is very, very simple. Context can help, but it's not necessarily going to be enough on its own. The value shows up when the context aligns with price, not when you blindly just bet one angle. All right, up to this point, we've looked at individual signals, market behavior, models, fundamentals, but the real edge comes from not just one factor. It's going to come when multiple signals point in the same direction. So, this is where things got a little bit interesting. So, when you combine low total dogs with teams coming off a blowout loss, you're looking at about a 67% hit rate and nearly 29% in terms of return on investment. That's not random, folks. The market thinks a team sucks because they just got blown out last week, not understanding that that low total is screaming a hard-nosed fought football game. Take that underdog. Let's move on to the second one, which is favorites in a high total game. This is paired with the travel angle. This also held up. So those high scoring environments with a team traveling over 620 miles is a no-brainer for that home team. And then when you layer in the third one, which is layering in travel, coaching, and matchup advantage all together, you saw stronger results as well. This is in also some elite close and line value at almost 80%. That is bananas. So you're talking about that's multiple independent signals all agreeing on the same side. You see a similar pattern with divisional dogs and low total environments as well. Talking about tighter games, inflated lines, and then more opportunities to beat that number. And even something as simple as the bottom one, home dogs and low total games, this showed strong returns. The takeaway is going to be simple here, folks. Isolated angles are really enough. The edge is going to show up when you start combining factors and when the price hasn't fully adjusted to that alignment. So you want to combine factors and have that close in line value. Now, this is just as important as what worked, and this is where the process actually broke down. Because if you're not identifying what loses, you're not refining your edge. You're just collecting data at that point. So the first thing that stands out is anything tied to public positioning. What do I mean by that? Talking about bet percentage. You're going to see that all over the place. And bet percentage showed up in these combinations performance, but dropped off very, very quickly, especially when it was paired with other signals like player ratings or even coaching. So you're looking at 36 to 41 in that span in terms of the win rate all over this board. Uh, some of the largest drawdowns that we saw all season. Even more important, a lot of these still showed positive closing line values. So this wasn't just bad numbers, it was the wrong interpretation of good numbers. So the market was moving in these directions, but the outcomes didn't necessarily justify it. The same thing shows up with the way teams tied to the public consensus indicators. And public consensus indicators just means the public, right? You're essentially stacking signals that are already priced in or worse, overvalued and expecting them to outperform. And that's where the edge kind of disappears. So the takeaway here is simple. Not all signals combine well. If your process leans too heavily on the consensus or popularity or even just who's hot, you're not finding value. You're basically just paying for it. All right, so this part actually matters. It's not opinions, it's not narratives, it's just what the data actually said over the full season. So first, the public got smoked. It's that simple. Majority bet sides won just over 41%, and that translated to a negative 21% return. So if you were consistently on the obvious side, you got your ass whooped. It was that simple. Number two is the price beat opinion. When we got closing line value, we were profitable. That simple. When we didn't, the results dropped off quickly. That difference between betting numbers and betting opinions, that's going to be everything, right? Third is going to be market resistance. This was an edge in itself. Contrarian positions, the uncomfortable bets, consistently outperformed the public this season. Not because they felt right, but because they were priced better. Let's move on to the fourth one. Models didn't carry on their own. Talking about benchmark, matchup model, player quality, efficiency. Even when combined, these were negative overall. The numbers did help, but they weren't enough by themselves. And let's move on to the fifth one. This is going to be situational dog spots. They showed up all season long. We're talking about blowout dogs, divisional dogs, dogs in low total games. These were consistently undervalued positions all year long. And then finally, we have the strongest results came when signals aligned. We showed it to you a couple slides ago, right? Not one factor, but multiple edges pointing in the same direction, especially in what most bettors would call ugly spots. That's where the market left the most opportunity. Okay, so if you take nothing from this video, please at least understand this slide and know what we just learned and what to do going forward. So let's see what we're going to carry into 2026. First, let's talk about what we learned in the first section, which is price over opinion. After doing this for a long time, you realize something simple. You don't get paid for being right. You have to understand that. You get paid for getting the best number. And that's what closing line value represents. It's the only objective way to measure if you're consistently beating the market. So going forward, the focus isn't just finding good teams, it's identifying the factors that lead to beating the closing line. Because if you're beating the number, the results will soon follow. Let's go to number 2 now, and that's models. Models matter, but they're not the answer. That's all people will come to my channel for. Build this model, build that model, do this, do that for this model. Let me see the technical fact. No, it's literally only 1/3 of your process. Why let it dominate your decision making? So for us here at Grandstand Sports Data, especially in the NFL, models are only a tool. That's all they are. They help you remove the bias. They point you in a direction, but they don't make the bet for you. That decision still comes from understanding price, market behavior, and context, especially in the NFL market. The third one is going to be being contrarian. The NFL is one of the most efficient, most public driven markets in the world. And when you consistently align yourself with the public, you get your ass cracked. That's simple. That's what the data showed all season long. This isn't about blindly fading the public, it's about being willing to be on the uncomfortable side. When the price and the situation justify it, though. Remember that. Lastly, fundamentals. Not necessarily narratives, not headlines, actual situational edges. We're talking about travel, rest, matchups, game environment. These are the factors that move outcomes, but only when they're priced correctly, because a good situation at a bad price is still a bad bet. So, what are we really looking for in our fundamental factors? Well, we want the first thing to be performance. Does it win in the betting market? If that's a yes, move to number 2, closing line value. So remember, we want both, not just one or the other. And when you go back through the data, the strongest spots weren't single angles. They were combinations. Low total, ugly team, contrarian spots, coming off a bad performance. Those are the spots nobody wants. And those are the spots that consistently paid your wallet. So the goal going forward is simple. Not more bets. We want better bets. Put yourself in the positions where the price is right. The market is leaning the other way, and your factors actually support the play. That's where long-term profitability is going to live. That's the 2025 NFL season through the lens of the market, not just the scoreboard. So if you found value in this type of breakdown, hit that like button. That's how we'll measure if you want to see more of these letters to betters moving forward across different sports. If you're serious about becoming a more disciplined, data driven bettor, subscribe to the channel. That's what we do here. No bullshit, just process. And I want to hear from you. Drop a comment down below what actually worked for you this season, and what completely crushed you. I appreciate you guys for watching. We'll see you in the next one.